Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Oxford Lane Capital.
If you find our talks useful, please consider subscribe, like, and comment underneath. So let's just get right into it today. Imagine taking out a massive new loan, right? But at a much higher interest rate.
Yeah, which sounds terrible.
Right, and then intentionally slashing your own paycheck by more than half. And on top of all that, watching your net worth just plummet to a fresh 52-week low.
I mean, for most people, that sounds exactly like a financial death spiral. Just total disaster.
Exactly. But in the ultra-complex world of corporate credit, there are actually a few people out there calling those exact moves a masterclass in long-term survival. And, that is the counterintuitive puzzle we are unpacking today with Oxford Lane Capital.
It really is one of the most fascinating stress tests playing out in the markets right now.
Yeah.
I mean, we're looking at a company making moves that actively infuriate their short-term investors, like genuinely make them angry. And it's entirely for the sake of surviving a massive systemic threat.
And that systemic threat has a very catchy, very terrifying name in the financial media right now. They're calling it the CLOpocalypse.
Which is quite the dramatic term.
It is. But for you, the listener, whether you are an income investor desperately hunting for yield, or, you're just fascinated by how complex financial vehicles navigate existential stress, this analysis is going to pull back the curtain.
We really need to look at the raw mechanics of how a management team actually clears the deck during a crisis.
Right. To understand if Oxford Lane Capital is just a classic value trap, a sinking ship that looks deceptively cheap, or if it's a rare opportunity for patient capital. But to do that, we have to start with the sheer scale of the damage.
The damage is significant. There's no sugarcoating it. And to understand why it's happening, you really have to understand the arena they operate in. Oxford Lane Capital focuses almost exclusively on collateralized loan obligations, or CLOs.
Right. So for anyone who needs a quick refresher, how does that actually work in practice?
To put it simply, financial institutions take hundreds of different corporate loans, they bundle them all together into one giant pool, and then they slice that pool into different layers of risk. We call those layers tranches.
I always picture this like a massive champagne tower at a wedding.
Oh, that's a good way to look at it.
Yeah, so the cash flowing in from all those corporate borrowers paying their interest, it's poured into the glasses at the very top first. Those are the AAA-rated, super safe tranches.
Right.
And once those top glasses are full, the cash flows down to the next level and the next all the way down to the bottom.
That is the perfect mechanical visual. So Oxford Lane Capital deliberately positions itself at the very bottom of that champagne tower. They target the equity tranches.
The bottom glasses.
Exactly. Yeah. Because they are at the bottom, they take on the absolute highest level of risk. I mean, if some of those underlying corporations go bankrupt and stop paying their loans, the champagne stops flowing before it ever reaches those bottom glasses.
Right, but to compensate for that massive risk, those bottom equity tranches also receive the highest potential return.
Exactly. Which brings us to the massive wave heading straight for that champagne tower right now.
You're talking about the $344 billion refinancing wall.
I am. The market is expecting this wall to hit between 2026 and 2028. It's really terrifying, the market.
Walk us through why that wall exists. Why are people so scared of it?
Well, this is where macroeconomics violently collides with corporate balance sheets. Think back to a few years ago when interest rates were incredibly low. Corporations borrowed heavily.
Because money was essentially free.
Right, money was incredibly cheap. So they took out massive loans with 5 or 7 year terms. Well, the clock is ticking now. And a staggering $344 billion worth of those loans are scheduled to mature between 2026 and 2028.
They have to refinance that debt.
Exactly. They have to refinance. But today, interest rates are significantly higher than they were back then.
So a company that could comfortably afford the interest payments on, say, a 4% loan, suddenly they have to refinance at 8% or 9%.
Yeah. And a lot of them simply will not be able to afford that new math.
Default becomes inevitable for the weakest companies in that pool. And remember, who takes the very first loss when those defaults happen?
The equity tranches at the bottom, the ones Oxford Lane holds.
Exactly. This systemic fear of mass defaults is what's driving the whole CLOpocalypse narrative. Generalist investors look at that $344 billion wall, they look at the potential for mass defaults, and they basically sprint in the opposite direction.
And that panic definitely shows up in the absolute bludgeoning Oxford Lane Capital took recently. I mean, despite having a remarkably solid fiscal year 2025, they pulled in about $97.97 million in annual revenue. The third quarter of 2026 was just brutal.
It was incredibly tough.
Their net asset value, or NAV, per share plummeted 19%, dropping all the way down to $15.51.
That 19% plunge is a direct reflection of how the broader market is pricing in the fear of that refinancing wall. Because Oxford Lane Capital operates as a daily NAV fund, they are forced to mark their portfolio to market value every single day. So even if nothing has actually defaulted yet, the fear drives the price down.
Exactly. In a risk-off environment where everyone is terrified of CLOs,
Yeah.
the market price for those equity tranches just collapses.
Yeah.
Even if the underlying loans are still paying, the paper value of the portfolio shrinks rapidly.
It's a vicious cycle of valuation markdowns and lower investment income, which leads us to the triage phase. Because the board just slashed the monthly dividend down to $0.20 per share for April through June 2026.
Yeah, that was a massive move.
But hold on, I have to push back here. Slashing a dividend by that much, that isn't just a reset to an income investor. It feels like a profound betrayal, you know?
Oh, absolutely. It hurts.
If I bought this stock specifically for that robust monthly check, seeing it violently cut like that is terrifying. How is this not just a management team desperately bailing water out of a sinking ship?
It's a fair question.
I mean, why should you, the listener, view a 19% drop in NAV and a massive dividend cut as anything other than a flashing neon warning sign?
Well, the initial reaction is always panic, right?
Yeah.
And it's entirely justified if you rely on that cash flow for your daily life. But analyzing distressed credit requires stripping the emotion out of the mechanics.
Okay, so take the emotion out. What are the mechanics telling us?
We have to look at why a company pays a dividend and how they actually fund it. If a fund is paying out more in dividends than it is earning in sustainable real-time cash flows from its investments, it faces a mathematical crisis.
Right, the math simply doesn't work.
To maintain that high dividend, the fund literally has to sell off its underlying assets.
Which means they're cannibalizing their own portfolio, basically selling the furniture to pay the rent.
That's exactly it.
And ironically, that just accelerates the drop in their net asset value, right? Because now they have fewer assets generating income to begin with. It's a guaranteed death spiral.
That is the textbook definition of a yield trap. Management teams that are terrified of their shareholders will keep paying that unsustainable dividend right up until the company just collapses.
They don't want to take the PR hit.
Right. By stepping in and aggressively slashing the payout to $0.20, Oxford Lane's board applied a painful but life-saving tourniquet.
They prioritized capital preservation over short-term popularity.
Exactly. They aligned their outgoing cash with their actual sustainable incoming cash flows. It is bitter medicine, absolutely, but it fundamentally shifts their trajectory from a slow bleed to potential stabilization.
Okay, so the dividend is slashed. The bleeding is theoretically stopped. But, you know, applying a tourniquet doesn't win the war. It just keeps you alive long enough to get to the hospital.
Sure.
Let's look at how they are actively restructuring their underlying foundation, because the debt juggling they executed recently is wild.
The moves they made in the credit markets are incredibly revealing. It tells us a lot regarding their internal strategy and their external credibility.
Let's lay out the timeline for the listener, because the sequence of events here is crucial. Going back to September 2025, Oxford Lane Capital was sitting on $65.0 million in post-IPO debt. Fast forward to March 2026, right in the thick of this market storm, and they managed to price a $60 million offering of 8.25% Series 2031 term preferred stock.
Which is a big move on its own.
Right. But here's the kicker. Just days ago, on April 1st, 2026, they turned around and immediately used the proceeds from that offering to redeem 2.8 million shares of their older 6.25% Series 2027 term preferred stock.
And any cash left over is specifically earmarked to buy heavily discounted CLOs.
Okay. But on paper, replacing 6.25% debt with 8.25% debt looks like a severe unforced error.
I know. It sounds completely backwards.
It really does. It's like refinancing your mortgage at a much higher interest rate, deliberately making your monthly payments more expensive just so you can extend the life of the loan.
Right.
And then using the leftover cash from the refinance to buy a distressed, foreclosed house next door. Explain to the listener why anyone would volunteer for a higher interest rate like that.
It sounds totally backwards until you realize what they are actually buying. They're buying time. Yes. In the credit markets, time is your most expensive asset, and they just bought a massive insurance policy. This strategy is known in the industry as duration extension.
Okay, duration extension. Break that down.
If you look at their original debt, it was coming due in 2027. Now, remember that $344 billion refinancing wall we discussed earlier?
Oh, right. It peaks right around 2027.
Exactly. So if they kept the old debt, They would be forced to refinance their own obligations at the exact moment the entire global credit market is choked with desperate companies trying to do the exact same thing.
Wow. Okay. So the risk of the credit markets completely freezing up during that window is incredibly high.
Insanely high. If they couldn't roll over that debt in 2027, it becomes an existential threat to the fund. They could go under.
So by issuing the new 2031 preferred shares, they push their maturity date 4 years past the danger zone.
Precisely. Yes, they are paying a 200 basis point premium, an extra 2% in interest, but that premium eliminates the near-term threat of bankruptcy. They successfully bridged the chasm.
But raising $60 million in the middle of the CLOpocalypse cannot be easy. The market is terrified of this sector right now. Who is actually giving them this money?
Institutional underwriters.
Yeah.
Firms like Lucid Capital Markets and Piper Sandler backed this offering.
Okay, so the big players.
Right. And this is a critical data point for retail investors. While the broader market is panicking and dumping the common stock, sophisticated institutional money looked deep into Oxford Lane's books.
They did their own homework.
They modeled out the stress of the refinancing wall and essentially said, we trust your balance sheet to survive until at least 2031.
And that brings us to the second part of my mortgage analogy, using the leftover cash to buy the foreclosed house next door.
Yes, the offensive play.
Because by clearing out that near-term debt, they completely changed their posture from defensive to offensive. Since the entire CLO market is in a state of panic, assets are being sold at deep, irrational discounts.
Oxford Lane now has the timeline security and the cash reserves to go shopping in a clearance sale.
So they are locking in structurally higher yields right now.
Exactly. When you buy deeply discounted equity tranches, you are locking in a structurally higher yield. If the market eventually stabilizes and the panic subsides, the value of those discounted assets will naturally rise back toward their historical averages.
That is how a fund engineers a massive recovery in its net asset value on the back end of a crisis.
It's textbook distressed investing.
So they are playing a very aggressive game of chess. They took the heat for cutting the dividend, they secured their timeline to 2031, and they are buying the dip.
That's the summary, yeah.
But looking at the actual stock chart right now, the market clearly hasn't gotten the memo. The common stock is lingering near a fresh 52-week low. It looks like a total washout.
It is a washout. We are witnessing a classic capitulation event. The investors who held the stock purely as a bond proxy, the ones who relied on that high dividend without understanding the underlying mechanics, they are throwing in the towel.
They feel burned by the cut.
Absolutely burned. And they are selling at what might be the absolute bottom of the cycle.
But this is where the dynamic between the common stock and the newly issued preferred stock creates a fascinating opportunity for the listener to consider. Let's look at those new 2031 preferred shares for a second.
Okay, let's look at it.
Because the broader market is so bearish on CLOs, those preferred shares are currently trading below their $25 par value.
Which introduces the really powerful concept of a yield floor.
Walk us through that math.
Sure. For anyone unfamiliar with the math of preferred shares or bonds, when the price of the asset drops below its face value, or par value, the effective yield you earn goes up.
Right. You're paying less for the same cash payout.
Exactly. Because these 2031 shares are trading at a discount, it pushes the yield to maturity up to a very attractive 9.04%.
Consider the psychology of panic selling for a moment. When retail investors are running for the exits, screaming about the end of the credit markets, a massive 9% yield floor effectively acts as a safety net.
It really does.
If the price of those preferred shares drops any further, that yield mathematically goes higher and higher.
Right. It would push past 10%, 11%.
Eventually, it hits a point where massive institutional buyers step in simply because they want to lock in a guaranteed double-digit return, which naturally stops the price from falling further.
The quantitative sentiment scoring across the market data highlights this exact dynamic right now.
What are the algorithms saying?
Well, if you look at the broader CLO market, the sentiment scores are overwhelmingly bearish. But when the algorithms analyze the sentiment specifically regarding Oxford Lane Capital's new preferred IPO, it ranks as neutral to bullish.
So the smart money is differentiating.
Exactly. The institutional market recognizes the safety of the duration extension, even if retail investors are still fleeing the common stock.
The panic selling exhausts itself eventually. The dividend cut is basically fully priced into the stock at this point.
I would say so, yes.
And by proactively redeeming those 2027 shares on April 1st, management sent a very loud, undeniable signal to the market they honor their obligations.
They prove their solvency in the middle of a storm.
which is huge. When you combine proven solvency with a 9% yield floor, it starts turning a highly bearish, terrifying chart into a potential basing pattern.
It creates a very solid foundation for patient capital to step in, collect a 9% yield, and just wait for the macro environment to recover.
But the structural setup for a recovery, while it's in place, patient capital still faces very real, concrete
Oh,
risks.
definitely. We can't ignore the
We
risks.
have to balance this bullish setup by examining the strict timelines and potential pitfalls over the next few months, because this strategy is a high wire act and the macroeconomic winds could still blow them off the line.
Absolutely. The primary systemic threat hasn't vanished. That $344 billion refinancing wall is still looming out
All
there.
right, the wall is still real.
If the broader market simply cannot absorb that massive volume of loan refinancing over the next 2 years, and the default rates are worse than the models predict, the CLO equity tranches could face even deeper, more violent valuation cuts.
Which would trigger another downward spiral in the NAV, turning this entire value play thesis into an inescapable value trap.
Exactly. And beyond the macro environment, there's a very specific internal metric we need to monitor.
Let's hear it.
The third quarter data showed $263 million of undistributed CLO equity income.
On paper, that looks like a fantastic cushion against future dividend cuts.
On paper, yes, but the actual coverage ratio, the measure of how safely their cash flow covers their obligations in real time, remains murky in this stressed environment.
So if corporate defaults rise rapidly across the underlying loans in their portfolio, that $263 million cushion could evaporate.
Poof, gone.
And if that happens, even the newly slashed $1.20 dividend could be threatened again.
Which is why the next 3 months are critical for validating this whole thesis. There are 2 concrete events and 1 highly speculative macroeconomic catalyst to watch.
Let's start with the concrete events.
First, the Q4 2026 earnings release in late May or early June is the ultimate proving ground. The entire market will be dissecting that report to see if the NAV decline has finally stabilized at that $15.51 mark, or if the portfolio is still bleeding.
And second, we have to watch the dividend declaration itself. Management promised that $1.20 payout for April through June.
Right.
If they confirm that $1.20 rate beyond June, it sends a massive signal of confidence. It validates the theory that the reset actually worked and their internal cash flows have stabilized.
Exactly. It shows they've stopped the bleeding.
But let's talk about the speculative catalyst, because this is where the upside potential gets really aggressive. It all revolves around the Federal Reserve.
The interest rate environment is the single biggest variable for leveraged credit vehicles, period.
So if the Federal Reserve decides to cut interest rates later in 2026, what happens?
It could trigger a massive market reaction known as a spread compression trade.
Okay, let's break down the mechanics of spread compression for the listener. Why would a dovish Federal Reserve, a central bank that is actively cutting interest rates, act like absolute rocket fuel for a company sitting at the bottom of the CLO champagne tower?
It comes back to the corporations that hold the underlying loans. When the Fed cuts rates, borrowing costs fall across the board. Suddenly, that terrifying $344 billion refinancing wall shrinks.
Because the math changes for those companies.
Right. Companies that were facing default can suddenly afford to refinance their debt at the new, lower rates. The risk of mass defaults plummets.
And because the perceived risk vanishes, the gap or the spread between the high yields demanded by fearful investors and the actual lower risk of the loans compresses.
The market basically realizes it was overly panicked.
So when that spread compresses, the value of the CLO equity tranches explodes upward.
Yes, because Oxford Lane Capital is a highly leveraged vehicle, a dovish turn from the Fed doesn't just help them incrementally, it acts as a massive multiplier.
Wow, okay.
If they're aggressively buying heavily discounted assets right now with their leftover cash, and then the Fed cuts rates in 6 months, causing default risk to vanish, the value of their portfolio will skyrocket.
It would cause a rapid, violent upward re-rating of their currently depressed net asset value.
It would be massive.
So bringing all of these complex moving parts together, what is the final verdict? Based on the analysis, the aggressive debt maneuvering, and the macroeconomic environment, Oxford Lane Capital lands a 6.5 out of 10 bullish score.
Which is pretty solid considering the fear in the market.
Right. But make no mistake, this is a high-risk, high-yield special situation. It is definitely not a set-it-and-forget-it holding for a conservative retirement account.
Definitely not. You have to watch it.
It is a calculated play meant for a 12 to 18-month time horizon. They took their bitter medicine by cutting the dividend. They cleared the deck by pushing their debt obligations out to 2031. And now they are using their remaining cash to go shopping for steep discounts while the rest of the market panics.
The entire situation really forces us to reevaluate how we perceive risk. We operate in a financial ecosystem that is entirely obsessed with daily price movements and quarterly
I
earnings.
want it now.
Exactly. We demand immediate, uninterrupted gratification from our investments, and we panic at the very first sign of a drawdown. But how much of what we casually label as market risk is actually just a fundamental misunderstanding of complex time horizons?
When a management team deliberately sacrifices its short-term appeal, when it willingly angers its own shareholders by slashing the dividend and taking on higher interest rates just to ensure it can survive a multi-year refinancing wall, you have to ask yourself who is actually acting irrationally.
Are the retail investors who flee in terror at a 52-week low making a rational, risk-averse choice? Or are they simply crystallizing their permanent losses, stepping off the playing field and handing all their future upside over to the patient few who took the time to understand the math?
The ones who are willing to stand on the shoreline look at that $344 billion wave crashing toward them and realize that management didn't just abandon the ship, they bought a bigger surfboard and a 4-year insurance policy. Thank you so much for joining us today. We will see you next time.